Holding out very, very smartly in trade, 20,400 thereabouts now in the Nifty futures and an all-time peak now. Rakshit Ranjan too joins in on the show. Rakshit, hi, afternoon. Can't take our eyes off from some of the power financiers today, and especially in the light of, the dhamaka that the IPO of IREDA has been, or for that matter, the listing gains thereafter. Wondering whether the meat of the rally is over, or do you think the story has just begun?
Well, when you look at the GDP print, for instance, from yesterday and the granular details within it, I think the economy is in a very good shape. One of the best positions that the economy currently is compared to any other situation over the last, say, 10, 20 years. So in that regard, there is certainly stability. This is whether this is a beginning of a long rally in the market or it'll be a lot more gradual. That's a slightly difficult one to predict from a short-term perspective, but from a long-term perspective, looks pretty stable and healthy.
So, yes, looking at the GDP print, looks like the demand is only going to increase. But Rakshit, what's the take on the auto sector? Because one was expecting in the month of November there would be some bumper sales that come out, but seems like they've missed the estimates by a bit. What would be your take on the auto sector? I know Marcellus doesn't have a lot of investments in autos directly, but even for the entire supply chain?
Yes. So when you look at the consumption piece, I think it's quite polarized. The urban consumption part of the economy is doing much better than the sort of small ticket consumption part, and hence within the auto piece as well, you would see those kinds of trends where small ticket consumption versus large ticket consumption would be affected by those two very different external environments facing that part of the economy. So I think that's certainly underway. Apart from that, yes, you're right. When it comes to stock picking, stock selection, we have relatively limited exposure here because barring a couple of companies, so for instance, in some of our portfolios, we've got Aisha. Barring a couple of companies, we don't see too many OEMs, barring a couple of auto anchor suppliers, we don't see too many companies having a lot of pricing power here vis-a-vis either the customer or their customers or their sort of OEM customers.
So where have you added position, or which area of the market interests you most right now?
So in our consistent compounders portfolio, more recently, we've added Trent. That was about 4 or 5 months ago. And the reason for addition of Trent at this point of time is our conviction rising in this company not being just an apparel retailer, but in fact being an incubator of various retail formats. Our understanding of how Star Bazaar is shaping up is adding to that conviction, and I think that's one very big area of undervaluation of Star Bazaar when you look at Trent in terms of its expected fundamentals versus what it might deliver going forward.
Okay, that's the take coming in on Trent. Rakshit, curious to know what is it that you've done in the last 2 months? Anywhere where you've trimmed positions or added afresh?
Yes, quite a bit. So in the banking space itself, we've increased allocation to some of the larger private sector banks because the share prices have lagged behind fundamentals by a very meaningful amount over the last 2-3 years there, and we think that is a big opportunity to benefit from. Even otherwise, there have been several allocation changes. On average, we've been doing about, say, 8 to 10% portfolio churn only related to allocation over the last year or so, and it has already started to yield healthy results. So some of the diagnostic players, for instance, Dr. Lal PathLabs is in our portfolio. We increased its allocation some time back. Divi's Lab we had increased, and as I said, financials as well. So yeah, those are some of the changes.
What about the specialty chemical space? Because that was one sector you guys used to focus a lot on. Any major additions or deletions there?
No, we are watching it very closely. We want to play it the way we see the external environment going through ups and downs. There were sort of inventory related, oversupply related challenges that the sector faced in the last 12 months. After a different series of challenges, which some of these companies actually benefited from during the Russia-Ukraine war and the supply chain challenges thereafter, so on and so forth. So yes, I think it's been a long time, and we are watching this space very closely. We do have some exposures here, which we are trying to play to our benefit in the portfolios through position sizing.
Right. Okay, the other spaces, of course, are the likes of an L&T, Axis, Asian Paints, Bajaj Finance. These are some of the names which are holding out today. There's SBI, ICICI Bank too has finally made a move at that 950 odd level. So that stock as well is holding up. Autos not. They're seeing a bit of a profit taking. And then, of course, they're the likes of an HDFC Bank, Kotak, etc., which continue to underperform as well. Rakshit, you just highlighted what you did with banks, but specifically on the underperformance that you've seen from the likes of an HDFC Bank or a Kotak, you think that might reverse in this very fast-pacing shift that you continue to see in the markets of late?
Yes, no, we do expect to see that reversing. So all kinds of overhangs, either related to management succession planning in some of those companies is cases or related to, say, some corporate action, so HDFC Bank and Limited merger. All of those sort of concerns that at different points of time the market had over the last 2-3 years on some of these stocks are behind us. We do see, in particular, let's say HDFC Bank, we see the benefits of the HDFC Limited merger being very tangible now when you visit the branches and understand how the consolidated entity is benefiting from synergies. And also valuations have become very attractive. And when you then look at some of the recent changes, for instance, RBI's recent increase in risk weights for unsecured loans, those kinds of changes, they directly fall in the lap of well-capitalized lenders, including well-capitalized NBFCs as well as well-capitalized banks. So those are some of the I would say tailwinds, the benefits of which we are looking forward to in the quarters to come, and hence, yeah, it's a very big opportunity, I think, to benefit from the dislocation in share prices vis-a-vis fundamentals that these large private sector banks have witnessed in the last couple of years.
One of those pockets where there's still some value on the table. But other than that, Rakshit, there has been a massive up move this year in the real estate sector. In fact, one of the best performing sectors. How would you suggest playing this directly through a developer, through probably some affordable housing financiers, cables and wires, durables?
So we are playing this via cables and via affordable housing financiers and some home building material improvement companies. We are not directly invested in real estate companies because of the sort of lumpiness in their fundamentals over a longer period of time after long periods of lull. The consistency in the fundamentals that we seek is something that we don't find available enough in this sector. And hence, I think when you play it via the home building materials or affordable housing, not only new construction, even on existing housing, you tend to benefit from the sort of developments there, the economic changes happening there. So renovation of houses, upgradation of home decor, so on and so forth, are many drivers of growth in addition to just new construction of real estate, which we try to benefit from in these spaces.
Okay, Rakshit, on that note, we let you go. Thank you so much for making time and speaking with us. But